Factors affecting financing decision. In practice, some of the important factors affecting the financing decisions are described as cost, risk, floatation cost, cash flow position of the business, level of fixed operating cost. In practice, some of the important factors, which means first one is cost. The cost of each type of finance needs to be estimated, and the source which involves the least cost should be chosen by the financial manager. It is generally presumed that cost of debt is less than cost of equity. Second one is risk. The associated risk is different for each source. For instance, the risk involved in raising debt capital is higher than equity. Therefore, higher the proportion of debt in the total capital is likely to increase the financial risk of the business. Floatation cost. The cost of raising fund is known as floatation cost. This includes money spent on advertising, printing of forms, underwriting commission, etc. A source of finance involving less floatation cost is considered to be more preferable. It is generally perceived that the floatation cost on equity is more than debt. Cash flow position of the business. If the cash flow position of a business is good, it should opt for debt else equity. Cash flow position of the business. If the cash flow position of a business is good, it should opt for debt else equity. This is because the issue of debt involves fixed burden in the form of regular payment of interest and repayment of principal amount. Therefore, unless the cash provision of a business is good, it will not be able to meet these commitments easily. Level of fixed operating cost. The successful running of a business enterprise involves a number of fixed operating costs in terms of payment of rent, wages, maintenance charges, etc. If the fixed operating cost of a business is low, it should opt for debt else equity. This is because if a business is operating on high fixed cost, the issue of debt will further add on to its fixed burden in the form of regular payment of interest and repayment of principal amount. However, if fixed operating cost of a business is less, it may opt for more of debt financing. Control consideration. The shareholders have voting right. Therefore, the issue of equity share capital dilute the control of existing shareholders over business, whereas financing through debt does not lead to any such effect. Therefore, if a company is under threat of a takeover bid, it is likely to prefer debt over equity. State of capital markets. If there is boom in capital market, it is easy for the company to raise equity capital, else it may opt for debt. This is because a rising stock exchange index boosts the confidence of the investors to pre-assume higher risk. So in short, factors affecting financial decisions, that is cost, which means the sources of funds which involve the least cost should be chosen. Risk. The risk involved in raising debt capital is higher than the equity. Floatation cost. The floatation cost on raising equity is higher than that on the debt. Cash flow position of the business. If the cash flow position of a business is good, it should opt for debt else equity. Level of fixed operating cost. If the operating cost of a business is low, it should operate for debt else equity. Control consideration. The issue of equity share capital dilutes the control of existing shareholders over business, whereas financing through debt does not lead to any such effect. Share capital markets. If there is boom in capital market, it is easy for the company to raise equity capital, else it may opt for debt.